Good morning and welcome back. It really is my pleasure to host this panel. We've got really wide-ranging topics ahead of us, and so I'm really looking forward to it. I'd like to just very briefly introduce the panel. I'm not going to use up a lot of time doing that. First up, we've got David McCarthy. He's an assistant professor at the University of Georgia and previously was a senior policy advisor for National Treasury, tackling aspects of retirement fund and social security policy and design. So welcome, David. It's really good to have you with us. Then we've got Claire Mole.
Thanks.
Claire is the retirement fund executive at KHUSA Consulting. She has over 20 years experience in the retirement fund industry, and she's really covered many roles as trustee, as director, as principal officer, and so has a fantastic understanding of retirement funds in South Africa. So welcome to you, Claire. Then I've got Lesego Mpete. She's a senior employee benefits consultant at Gradidge-Mahura. She's a registered financial planner, and I lost count of the qualifications she has, so eminently qualified to talk to us about the employee benefits industry. And then lastly, welcome to Lesego. And then lastly to Louis van der Merwe. He's a financial planner and director at WealthUp. And I think what's quite useful in terms of his perspective is that he gives advice to individuals and companies, so spanning both the retail and the institutional space, and he has a passion for technology and entrepreneurship, so another very different perspective. Welcome to the discussion, Louis.
Thank you.
I'd like to start with a sort of an opening question, and perhaps I can pose this one to you, Claire. You know, we've been asked to talk about the challenges affecting members, affecting employers and financial advisors. In your view, what is the biggest challenge affecting either of these three groups in the retirement employee benefits landscape in South Africa?
Thank you, Richard. So for me, I think it's all about education. I certainly don't think members in the whole really understand how their benefits work. I don't think employers themselves have done sufficient with the service providers to ensure that members truly have got to grips with understanding their benefit entitlements, and therefore you find members woefully short at the point of retirement or exit. So I think as an industry, if we could take significant stride forwards in appropriately communicating a message that's digestible to membership and to the employer, our retirement fund landscape would be in a far better position than it is today.
I completely agree with you. I mean, the outcome for people retiring is woefully short of what we needed. Do you think education will fix that? Is that the gap that's leading to, you know, to such, let's call them, poor outcomes at retirement for members?
I think with education comes accountability, and the better membership and the employer are educated in terms of the retirement benefit landscape, the more accountable the service providers will be, and the more members themselves will participate in mapping their own outcome.
Excellent. I think maybe a slightly optimistic view. I think many of us that have been involved think it's going to take a little bit more than that. Maybe we can return to that topic, but yes, that's certainly a big issue on the table. Lesego, maybe I can turn to you. Would you like to have a go at answering the question? What do you think the biggest challenge, the biggest gap in the landscape is?
I would like to agree with Claire with regards to education. It is very important that members understand the benefits that they have. I think another thing, if we look at the retirement fund landscape in South Africa, we've got companies that are trying to implement benefits for their employees in the SMME market. And it's quite difficult for them to find suitable structures that will benefit them in terms of from a cost perspective as well as their members. So I think from a benefit perspective or employee benefit offering perspective, there's also a challenge for the employer with trying to find the best solution that will actually assist their employees when they want to start up a retirement fund and make sure that they're assisting their employees with suitable retirement outcomes in the end. So I think for me, that's one of the key challenges that we are currently facing within the employee benefits landscape.
Excellent, thank you. And perhaps Lou, you could come in and put forward what you think the biggest challenge is.
Richard, I want to add on to what Claire said, but I think the problem lies in the behavior of the members. And so legislation is almost pushing us into a direction where we're creating more complex systems, creating more challenges for members to do the right thing. We know that there's very few things that we can control. Our decisions and our behavior around that is one of them. And so what we're struggling is having that balance between helping someone plan towards something that's very far for most members, but also tackling the immediate needs, the day-to-day expenses that they need to cover. And our legislation is coming around trying to make that a little bit easier to try and tap into their savings, which ideally this money is there to supplement you during a time when you cannot generate an additional income stream. So I think complexity in the system, and with complexity comes increased cost, increased legislation, and so I think we're moving in the wrong direction personally.
I'd like to explore that some more as well. So that's very interesting. But I think to get everything out on the table, let's ask Dr. David if he'd like to have a go at what he sees as the biggest challenge.
Yeah, well, I'd sort of like to change tack a bit and say that, for me, the biggest challenge that I see, or one of the biggest challenges that I see in the South African landscape at the moment, would be infrastructure investment. And the role that pension funds can play in facilitating infrastructure investment and how that should happen. And, Treasury, as far as I understand it, has changed Regulation 28 to increase the amount of pension fund money that can be invested in infrastructure. And by infrastructure, I mean things like energy, especially renewable energy like solar power, but also roads, sewage, water, airports, ports, all those kinds of public infrastructure where the public balance sheet may be stressed and pension funds provide financing opportunities. But my plea to both pension funds and regulators is that pension fund investments, in my view, should be listed rather than unlisted. I would encourage pension funds to invest in listed securities, and I would encourage infrastructure providers to list their securities to allow pension funds to invest in them. And the reason for this is that South Africa has deep financial markets, uniquely among developing countries. The financial markets in South Africa are sophisticated and deep, and pension funds and infrastructure providers should use those markets to protect pension fund investors. And there are various reasons why that is. The first is price discovery is provided by markets, so it protects the fact that the security that you're investing in is traded rather than unlisted. Provides an additional layer of protection against fraud from the point of view of the investor. The second advantage would be that project management is done by experts. So pension funds don't need to get involved in project risk, which is something that the Actuarial Society emphasized when the Treasury changed Regulation 28. It may reduce tax complexity in some way if pension funds invest by listed securities. With Treasury changing to the two-pot system, liquidity is important from the point of view of pension funds, because it's going to be very hard, or much harder, to predict pension fund outflow. And if securities are listed, then pension funds will find it much easier to deal with liquidity challenges. The fifth reason is that investing in listed securities rather than unlisted ones enables diversification. And the final one is that it would open the market to smaller pension funds. If providers, entrepreneurs don't list their projects, then they limit their funding sources to large pension funds. And I think that there are a lot of small pension funds that would also benefit from being able to invest in listed securities.
I think let's stay on this theme just for a short while before we return back to some of the points that were raised. David, it's very hard to argue with you around that listing these projects, whether it's the debt or the equity, would be a better way to go about it. I think your points are very well made. I certainly agree with that. I think that's just the transparency alone would have significant benefits. But is it really the job of pension funds? I mean, aren't we adding too much burden to what a pension fund's supposed to do by expecting them to solve the infrastructure collapse and issues in this country? I mean, we've heard about how members are struggling to get to the end with enough money to live off. Now we add another demand. Is that fair? Should we be looking to members to shoulder this cost? Perhaps you want to respond first, and then others can chip in.
Well, that's certainly one way to look at it. Another way to look at it might be that by listing infrastructure investment, what you're doing is you're providing pension funds with a greater range of investments that they can allocate their capital to. And of course, that's the primary function of financial markets, is to bridge the gap between savers, people who are saving for their retirement or for a rainy day under the two-pot system, and investors in the economic sense, that is, people who have projects that need financing and can get the financing from savers. I mean, that's the primary function of financial markets. I'm not suggesting that pension funds should only invest in infrastructure. I'm just saying that adding to the different range of investment options that pension funds have available cannot possibly be a bad thing. And the capital to build all of this infrastructure is going to have to come from somewhere. And the two alternatives are through the public sector. We'll know the challenges that the public sector has in South Africa at the moment, or the private sector. And so provided that the risk-return ratio is appropriate, and of course one of the great advantages of listing these securities is that the market sets the risk-return ratio, consistent with the risk-return ratio in all other securities. And therefore that provides the protection that I think pension fund money deserves, precisely because it is pension fund money. And so it is the money that people are going to rely on when they retire. So
if I can interpret or put it a slightly different spin on that, as long as the market is left and free and retirement funds are not compelled to invest in projects, it can be for members' benefits. The moment there's an element of compulsion, then you potentially have a distortion of prices, and you could have a drag on returns that members shouldn't really be penalized with. But as long as the members and the trustees and everyone else is free to deploy the capital wisely, then it can only be a good thing for all of the good investment reasons you've laid out.
Absolutely. I mean, over the last few years, there have been various attempts to use pension fund money to achieve, certain specific objectives. And, I can think of, there was a time where the banking industry needed capital desperately. And so they were thinking about trying to use pension fund money to support the banks. There was the green transition, and there was sort of this desperate way to use pension fund money to try and support that. Then there was the public balance sheet, how to use the pension fund money to save some of the public entities from their difficulties. And, all of these are possibly worthy in their own right. But the fundamental point that I think should always be remembered, and that is that the money in pension funds doesn't belong to society in general. It's there exclusively for the benefit of members. And so it's their money. And so, and it should always be invested in a way that is consistent with the ultimate needs and requirements of the members themselves. And so pension fund money is not there to green the economy. It's not there to save the banks. It's not there to protect the public sector against its own mistakes. Pension fund money is there only and exclusively to provide retirement benefits to members. and all other considerations should be secondary. And of course, this is a principle that's enshrined in pension fund law in many countries, including the European Union, where it's the first term in the European Directive on Pension Fund Investment. In the United States, the fiduciary law that applies to pension funds is extremely strong. And in South Africa, pension fund trustees do have a fiduciary duty to members. And that implies that pension fund money should not be used to support any particular agenda, no matter how worthy it seems to be, unless and until that's consistent with the broader interests of members, and that, in a financial sense, can be viewed in a return kind of sense. So the risk that pension funds are taking on is commensurately rewarded by an appropriate return, and the best way we have of setting those risks and returns is through listed securities on financial markets.
Excellent, thank you. I mean, I think you're preaching to the choir a little bit. I'm sure that we're going to have very few of us are going to disagree with you on those points, but they are extremely well made. And unfortunately, some of those challenges you just touched on haven't gone away. And so I think it's very important to remember that pension funds are not here to sort out, the public purse. They're not here to green the economy. They are here to make sure that members can live in retirement or of course cater for other benefits. So I think that's a great point. Well done.
Richard, you say that, but I mean, yesterday in the Wall Street Journal there was an op-ed written by 7, I think, attorneys general who've written to large fund managers in the United States, complaining about ESG and the extent to which ESG stands in the way of the best interests of pension fund members. So it's not as clear-cut as you might make out, I think.
No, I agree with you. I think that's a significant challenge, and it's with us. I'm going to return to some of the points that were raised by the other panelists, but because I think that's well noted. So at least 2 of you mentioned education, and there've also been 1 or 2 responses from the questions. And please do feel free to send through questions if you're listening in and want to join in. The questions about education and whether that's really going to move the needle, and surely the system must do better. It must produce a better outcome. And merely educating members is not necessarily going to move the needle on that. There's proposals to maybe educate people in schools and make sure that we start with better financial literacy and educating people in schools. School-age children don't really want to think about retirement, and just trying to get them to think about their careers and their jobs is hard enough. I worry that we over believing in the benefits that education can do in fixing this problem. Does anyone want to take me on that?
Sure, Richard. If I could maybe make a comment on that. I just want to comment on Dr. McCarthy's opening point. So I think prescription is an issue, right? So as soon as you are determining and defining and controlling where the money is invested, you have a degree of responsibility to ensure that people that there's appropriate pricing, that it adds significant value, and if it's on an optional basis, it makes certainly a lot of sense. But to obligate it is hugely problematic. So from an education perspective, I think in a world free from restriction, it would be great to have some degree of financial hygiene taught in the schooling system, because I think that's where that foundation starts in terms of people understanding, first of all, their responsibility in their retirement outcome, and then making sure when they go into the employment market that they participate within their retirement fund. For most members, when we affect communication and they really understand how the retirement fund structures and the associated risk benefits work, they are only too pleased to have that conversation with the employer in terms of then possibly doing an AVC contribution into the fund, or assisting in saying, I do have a degree of investment flexibility, so maybe I need to better understand that. And I think we've been woefully short as an industry in, first of all, either assuming that the information is is too difficult to communicate, so we don't communicate it, or assuming people automatically know that, so we just then don't communicate it. In our engagements, the more we communicate with members on the ground in a form and a medium that they really understand, we find that push between member participation and the employer participation really gives you a significant chance for the member to retire successfully, with the responsibility of knowing that most people have only got their company retirement fund. They actually don't have any other savings. So it's such a big responsibility to make sure, if this is the only savings vehicle members have, that we can give them the best results in making sure that it is a significant component to the outcome.
Yeah, you've convinced me, I think. That it was very clear. But yes, Louis, why didn't you come in?
Richard, there's a saying that if all you need is additional information, then we'll all be millionaires with six-packs. And so, yes, I agree that there's an element that we need to bring in education. But if we look at default behaviors and default investments, that drives like a much bigger element of behavior, right? So I think it's important that we bring across information in a clear manner, but not information that can damage that person, because a little bit of information is oftentimes detrimental to that person's longer-term financial planning. So I think it's the right information at the right time, but with that, the right guidance. And unfortunately, I think the retirement counselors their hands are tied a little bit in terms of giving enough guidance in terms of what would actually be good for this member, because most of the employees that we have conversation with and clients in the business, they don't have the bigger picture, right? And so just zooming out and helping them show the impact of their decisions, we find it's much easier for them to say, okay, I'm comfortable with these trade-offs. If I do this, I understand the impact on the rest of my financial life.
Sorry.
Please go ahead, Lesego. Let's go for it.
If I can just reiterate what's been mentioned so far. I think it's not as simple as just purely educating members on their benefits. I think with what the experience we've had is that the conversation has to start with dealing with financial literacy, the basics of financial literacy. And that is what we try and encourage when we do speak to our members. Started from the base where you explaining different various investment products, for example, savings options, and speak to members at a level that they understand. You know, if you're speaking to a group of individuals who belong to stokvels, for example, they understand that. Put it into a context that they can apply in their own personal lives. And then from there, you build on what they're currently doing with their employer and how that fits into the picture that they currently have. You know, sometimes we're so focused on trying to get the members on a suitable retirement outcomes that we're not looking at where are they currently? Where is the member? Where are they saving? Are they saving? You know, have that basic conversation first. Definitely should be introduced in schools. I feel, you know, it's something as simple as a piggy bank. I don't see those anymore in the shops. Those simple concepts can then be built on to get to the stage where we can have more complex conversations. As Louis mentioned, the retirement fund industry is about to get a little bit more complex with the introduction of several regulations over a short period of time. I mean, to get to the stage of annuitization has taken us close to over 10 years with consultations. Now we want to throw in a two-part system and auto-preservation or compulsory preservation, so that's just going to overcomplicate the current situation. So how do we start the conversation with our members, or how do we guide our members through the process that they're all going to go through? We're all going to get to a stage where we need to retire from our employment, but start where the member is. And just to add on to what David spoke about with regards to infrastructure, I think, again, if you look at your bigger funds that are maybe in a mining community, your infrastructure development, does it talk to that community? Because those trustees will want to know, right, we're investing in infrastructure development, but what does that mean for our members? What does it mean for them on a day-to-day basis? I mean, when you get to retirement, things like healthcare becomes expensive. So oftentimes they have to revert back to using state facilities. So are we using those funds for an infrastructure project that will develop the healthcare sector within informal or areas that are more rural? So those are things that I think as a landscape from the employee benefits perspective, if we can change the conversation for discussing where members are and then assisting them with where we need them to be in terms of outcomes.
Thank you, Lesego. Yes, go for it quickly, David. That's fine.
Yeah, I don't know how much time I've got, but I'd like to say that I think everything that the panelists have said about financial education is important and welcome. The problem with education, and I say this as an educator, is that firstly, you can take a horse to water, but you can't necessarily make it drink. And secondly, the returns to education take a very, very, very long time to happen. And so the question is, well, what do we do in the meantime? So while we wait for this cohort of well-educated and financially literate people to reach retirement age, and my view would be that it's very important for pension fund trustees to ensure that their funds work in a way that the right thing happens by default. So, and I think this is a point that Louis made. And so the focus of Treasury regulation, as I understand it, for many years, has been to create a regulatory environment in which pension fund members don't need to exercise much discretion, precisely because the funds are well designed, and that includes, when they join the fund, the default investment, when they change employers, the default preservation, and when they come up to retirement, the default annuity strategy, so that the right thing happens automatically without requiring much input by members. And I think in the short term, while we wait for financial education to improve people's financial literacy, that's something that we can do to help members. And I also want to say that I haven't been to a conference in a country, no matter how developed, whether it's Switzerland or Sweden or America or Canada, where people don't complain about the low level of financial literacy of pension fund members. So this is not a South African problem. It's not that South Africans are uniquely uneducated. It's something that's absolutely broad. And so I think, the focus of pension funds in the meantime could be on ensuring that the right thing happens by default, by ensuring that the default options are the correct ones for members, broadly speaking.
Yes, I'm glad you brought us back to that, David, because that's exactly where I wanted to ask Louis about. He mentioned defaults, and that's one of the changes that's already in play. And my understanding is that funds, really have to think quite hard about the defaults. And I wanted to ask whether we already starting to see a change in behaviour, and whether any of you actually who are closer to the funds and members can actually see improved decisions by members because of the defaults. Are they working? Are we seeing good defaults, and are we starting to see improved behaviour, or do people ignore the default and do something that is not smart? Any practical, real observations starting to come through?
So I think the defaults have been a great start. I think a lot of people, now that they have access to that as an automated event, have certainly not necessarily just exercised drawing money out of their retirement fund. They are using those default options. But again, I think it's really just a start. I think we need to do considerably more to make that, almost kind of a guaranteed option for members to go into, as opposed to those that are applying themselves on the exit to make use of. But it's a great start, but certainly hasn't gone far enough.
Louis, you're smiling. I'm hoping that means you wanted to add to that.
Richard, I think the single biggest thing that the defaults have done is the in-fund preservation. What we're seeing when people leave employers for various reasons, the fact that they have to do nothing to keep their funds invested in a retirement fund is probably the single best thing that I've seen. That means that people tend to accumulate more money towards their retirement. Sometimes they even park it and they forget about it, which is brilliant if you think about retirement planning. The part that's challenging, though, is the confidence in the system. So the challenging part that I would like to see default regulation is maybe around the contribution levels. Because at the moment, if given the choice, a lot of employees tend to opt for the lowest contribution amount because there's a lack of confidence in the system. They maybe don't understand what they're being invested in, but also the intervention of government in potentially using these funds in the future. So I think that perception is really difficult. You know, it's a marketing problem around retirement funds more so than anything else.
Sorry, just for my understanding, most funds where there's a choice in contribution levels, is there a default? Are members, is there a default level which a member would know this is what they should contribute even if they choose to contribute less?
Correct, and that's set on an employer level, so it's not governed by regulation.
And so if I hear you right, you're saying you think that a number of members would opt out of that, not because of affordability, but because of issues of trust and confidence.
Yes.
That's, I think that's quite, on our list of challenges, of which there are clearly many, I think that's quite high up there. We touched, I think, Lesego, it was you, but I think we're all interested in the changes that are still to come. The two-pot system and what that means for annuitization and preservation. Would anyone like to give it the I'm challenging you to 1 minute, just explain for all of us so we're on the same page what the changes are, and then we could perhaps have a discussion around what that will do and life post those changes, because I think they're quite significant.
Yeah, I'll share my insights on that. So the proposed changes that government is wanting to introduce is the idea of a two-pot system where members will essentially, with their retirement savings, a third of that money, future contributions, they will be allowed to access without needing to resign from the employer, with the balance of the two-thirds then needing to be preserved and them not having access to it should they leave the employer or whatever the case might be. I think with regards to that, it's still at proposal stage. It's still in consultation where Treasury is asked for comments from industry. But I think if I can just, from my perspective in terms of my opinion, I think they're trying to, so initially it's due to the fact that during COVID-19, people were in financial difficulties and they felt, I've got all this money sitting in my retirement fund, surely I should be able to access some of it, not all of it, to try and assist me to get out of a financial predicament, which I think South Africa as a country, we've got a poor savings culture. So that just highlighted the fact that South Africans don't have emergency savings. They don't have a plan B should anything happen where they find themselves in difficult financial situations. And what government is trying to do, and I think they did this also when they introduced the annuitization, is sort of a something for something type of approach when it comes to introducing new legislation. The two-pot system, what it does is it says, okay, we're trying to get people to preserve their money or get their money to follow them. But what do we give them in return for them to save for their own financial future in terms of their retirement? So how about we introduce something where they can access funds in the event of an emergency? And therefore, the two-thirds, like I said, the balance would then need to follow them through right to retirement. So it's still to be unpacked and more discussions that should be had, but I think that's just a simplistic view from my side in terms of that new legislation that they are currently thinking about.
So I think it was yourself, but it might have been one of the other panelists that mentioned, that every time there's a change, the complexity factor goes up. And so we're making a system that with the layers and layers of changes, eventually is going to be so complicated, you'll need to be smart enough to be on this panel to understand it, and that would really not help members because they're faced with an ever more complex environment. Of course, there's a trade-off, right? If every change makes things more complex, but some changes are actually positive and bring more benefit. Where do you think this sits? Is this a change that is just adding complexity for no benefit, or do you believe that in future we're going to see increased preservation, improved retirement outcomes, despite having to deal with a bit more complexity in the system? Who wants to have a go at a perspective of where these changes sit? Claire, you want to come in first?
Yeah, so certainly that would be utopian, right? So you have a direct cause and effect between these structural changes and better outcomes for members and people doing auto-preservations. Wouldn't that be amazing? I think the two-part system is quite progressive within our South African environment. It does kind of convert retirement funds to more of a preservation type thinking, though. And again, if you're going to allow members access, then the retirement fund is going to get diluted to a large degree in terms of the end result. But again, if members have got access to their money and you can help guide them in terms of good decision making, you might change over a longer term. So back to Dr. McCarthy's comment, this is definitely a long-term game. We're not going to see significant changes in our environment in the short term, but we've got to lay the foundation somewhere. I think that foundation starts at schooling. It then starts at entry-level jobs, and then it's a joint responsibility between the financial services sector as well as the employer and the members, understanding how significant the company retirement fund is to the end retirement result. And I think then over time, maybe Dr. McCarthy, not in my lifetime, but certainly I'm hoping in the younger generation's lifetime, we're going to see a significant change to the way that people understand how their money works and what that end result looks like. So for me, I'm cautiously optimistic. I think some of the legislative changes have been really progressive. Like Lesego's comments, I don't think a lot of them have been entirely thought through. So it's a great thinking in terms of the two-part, good and bad, but there's significant implications in terms of tax, administrative strain, how do you verify the spend, a whole range of things, moving money between providers, how do you ring fence it separately, how do you then access that on retirement? So there are a whole lot of things that I don't think have been significantly thought through before we can launch this. But because it was spoken about in the budget speech, we've been inundated with members saying, hey, how do I access my money now? And you're like, hold on. It's not available just yet.
Thank you, Claire. Louis, did you want to? I thought you were also wanting to contribute on that question on the two parts.
Thank you, Richard. I think if we look at the industry, I mean, a lot of funds have moved away from things like housing loans for a specific reason. It becomes complex. Members have the wrong expectation. And so with this new legislation, I would have liked to have seen more of an incentive for someone to bring back a little bit more confidence, saying, well, I can contribute to this retirement fund, and yes, I therefore now have a little bit of access. But actually, we're taking more away. We're taking access to money away, which means that people are less confident investing in the things that we want them to contribute. If it was really about access to money, why not just make a tax-deductible contribution to a cash pot that the employer can facilitate? I think we are almost trying to get members to follow the route of the legislation, and most likely we will have to, and educate and so help them to see the impact so that those default options can actually work to their benefit.
It does sound a little bit like you want to have your cake and eat it too. Let's have all the access, but let's try and get preservation up. I think I'm not sure you can do both, but it's still a very, very interesting challenge. There's been a question that's come through from one of our listeners, thank you very much, around defaults on retirement rather than sort of default preservation and default investment choice and contribution rates. In other words, do we have any data, any information on the take-up of defaults at retirement stage? And the question implied that our listener thinks it's very, very low. And are those working? And is enough thought being paid to the choices of retirees when they're actually at retirement, and whether the defaults are working for them? Do any of you who closer to the funds have a perspective and view on that?
Again, I think
Yes.
just low activation, right? So great initiative, but low activation. Certainly not the numbers that I think were anticipated when this piece of legislation was applied. Lesego, I don't know if your experience has been very similar to that.
Yeah, I tend to agree with you there, Claire. I think also it talks to, I mean, part of that default regulation was the issue of retirement benefit counseling. So the objective is to try and get these conversations around the default annuities to members prior to them actually retiring. So a couple of months before or a couple of years before the member goes on retirement. And I think that would be the differentiator between the uptake of those defaults, because oftentimes members are being consulted when they are retiring in that month, or they're retiring probably 3 months before, and by then a member's already made their decisions on what they want to do regarding their retirement. They're aware that it's coming, so I think to see an uptake or an increased uptake, some of the funds that we do retirement benefit consulting on, we've seen that uptake increase because of the fact that we engage with them prior to, so a year before, 2 years before in some instances, where they know what the options are in terms of the annuity strategy that's been implemented by the fund, and therefore they can make a more informed decision closer to the time if maybe there's some issues that they haven't considered. And also that is also an opportunity. I know we're hopping on about education, but it's also an opportunity to educate members on the different annuity options that are available, which need expert advice. You know, they need expertise for somebody to unpack those kind of annuity strategies that are available to them, either through their default, within their default structures of their retirement fund.
So, Lesego, if I'm hearing you correctly, you think the problem, if I can call it a problem across funds in South Africa, is more about the quality of retirement benefits consulting and offering that early enough to a member rather than the default options themselves. And so if we've got low take-up of the default, we shouldn't go and try and fix the product. We should go and have a look at the support that's being provided to members. Is that a fair paraphrase of where you stand on this?
So yes, the product itself, we understand how annuities work, but the issue is, or the challenge is, in the context of this conversation, is the fact that these members are not being consulted on or being educated around the products themselves. So, I mean, a guaranteed annuity, we might know how that works. A living annuity, we know how that works. So explaining those in the context of the member's plan or the member's retirement vision for themselves is what I'm saying is the issue. Yes.
Right. I think we've got time to squeeze in one last question. We're going to have to move reasonably quickly on it. And that's a question that's come through on fees and costs. And you know, whether the regulator should actually go further and actually regulate charges in retirement funds to make sure that members get the value and that the service providers, you know, are not overcharging members. And so, would the panel agree that fees and value for money for members in retirement funds is a key challenge? Anyone want to have a quick response? We can't all chip in, so.
So I think it is a challenge. I think it's less to do about regulating it further and more to do about transparency. People need to really understand what the fees are. So I think the investment fee disclosure that's now in place has been a really useful experience, but I don't think it goes far enough. I think that needs to apply to all cost deductions out of a retirement fund so that that transparency members are understanding what the erosion levels are looking like.
Do you think that disclosure is really enough? I mean, surely we've all seen examples of reams and reams of disclosure, and still, you know, not a great deal for the person buying the product because they don't know what they're looking at. So does disclosure of the costs move the needle?
I think disclosing the costs moves the needle slightly, Richard. But what we need is, like he's saying, the transparency is explaining what those costs are and where they deducted from. If you look at retirement funds, it's your administration fee that gets deducted upfront before your investment is actually made, and also the investment cost, that is your investment management fees that are then deducted from the assets themselves. So explaining that to to members or to the retirement fund around where the costs are, where are they being deducted, and the impact that that cost has on the contribution or the investment itself. I think that's what the disclosure of the information is one thing, but then analyzing where it's being deducted from which source is also important.
Excellent, thank you.
Can I just say?
Yes, David, go for it. You're getting the last word.
One thing, for those people who think that a charge cap is a good idea, I would just like them to think about, retirement funds are very complex, but just think about something like a cup of coffee. So would it be, we all agree coffee is far too expensive. So would it be a good idea for the government to impose a price cap on something like a cup of coffee? And you can immediately think about all the problems that will cause. And of course, the retirement system is infinitely more complex than the coffee distribution system, says someone who knows nothing about the coffee distribution system. And so, just think about the challenges that a price cap on retirement fund costs would create. And in Britain, where they imposed a price cap, I don't think that the outcomes are anything to write home about. So Britain may well serve as a warning to those people who think that legislating prices by fiat is a sensible way of dealing with market problems.
Thank you very much, David. That is a good analogy, and I will. I don't want you to keep us from our cup of coffee. Thank you very much to the panel. It was a great discussion. You touched on a number of interesting points, and I enjoyed it very much. So thank you very much, and we'll be handing back to the studio.